Braxton Worth, CBW, for what he's seen in the charts. And Carter, I don't like rude awakenings. So take us through what exactly is going to startle me besides my alarm that sometimes goes off at 2 in the morning.
Exactly, Dom. You know, I think it's what Karen said. I mean, the results are likely okay. Hard comps notwithstanding, it's all about just one thing, how the stocks react, which is to say there's no such thing as good or bad results. They're only results. And how a stock reacts to those figures, those results, determines whether it's good or bad. And exactly 3 months ago, it was a Monday, April 12th, this being the 12th of July, we were setting up for the week of big bank earnings, and the numbers were darn good. And the stocks basically never followed through, with relative performance peaking that month and have been downward sloping ever since. I might have a few charts there. I don't know if you have them on the screen, but if not, basically the thing to look at here is how banks, despite making new all-time highs, the BKX index finally just in the past 4 or 5 months getting above its 2007 peak. That's a long slog just to get back. The relative performance continues to be uninspiring. And so the question is one really compensated for the risk and the beta associated with a very cyclical area of the market, financials and banks in particular, versus the market overall? And in principle, the answer has been no. Now, there are always ones that are better, and I have some favorites. If one were to just look at the big financials reporting this week, I think BlackRock's going to be okay. Goldman, Morgan Stanley. PNC also a favorite among those reporting. But Citibank, on the other hand, Wells Fargo, not so good. Bank of America does not look good.
All right. So Carter, if it doesn't look good, what exactly could make it look better for some of your not so favorite picks? Are you watching the charts behind the 10-year yield that closely? Is that what's going to drive the trade for all of these? Is that the tail that's kind of wagging the dog, or vice versa?
Yeah, not so much. I mean, obviously, financials, industrials, all cyclicals have had a bit of a tough go here lately as rates have dipped as low as 1.25%. But here back at 1.35, 1.36, I think rates are sort of where they belong, if you can say such a thing. And that's not really the driver now. Now it's going to be about comping against very hard numbers, hard to comp against, from the trading activity, and also just the general risk that we are seeing some peak economic data, and by association, maybe time to be, of course, more defensive and less cyclical.
All right, so there's the call. Of course, interest rates at the level they should be is going to be something there. Thanks very much for that, Carter.
Shepard Smith here. Thanks for watching CNBC on YouTube.